Tidewater Midstream just missed basic EPS consensus by nearly 26%. But if you looked at your trading screen this morning, you saw the stock gap up and immediately test a 52-week high.
Right, yeah.
So we're going to dive into why the market aggressively ignored that bottom line today. Tidewater Midstream and Infrastructure, TSX ticker TWM, reported Q2 2026 earnings with a massive top-line revenue beat. Consolidated revenue came in at $552.10 million.
Which is a 62.1% year-over-year expansion. I mean, it completely crushed the $255 million consensus.
Exactly. But on the bottom line, reported basic EPS was C$2.68, missing the C$2.9167 consensus by over 23 cents per share.
Yeah, but in that same release, management materially raised full-year 2026 consolidated adjusted EBITDA guidance by 20% at the midpoint.
Wow.
Yeah, moving the target to a range of C$230 million to C$250 million.
Sure.
So the market clearly rewarded the operational beat over the GAAP EPS miss.
Right. Pre-market shares rose 2.01%. They gapped up 4.11% at the open and tested their absolute 52-week ceiling at C$23.12. They eventually closed the regular session up 1.82% at C$22.32 on heavy institutional volume.
You know, the divergence here between the headline earnings per share and the actual share price action is just a textbook case of institutional capital decoupling from automated sentiment. Like the algorithms sell the EPS variance while the institutions buy the underlying cash flow.
Right. And we really need to reconcile this JAP bottom line with the actual cash the underlying assets are generating, because a 26% EPS miss is a notable variance.
So absolutely.
If you were scanning your morning alerts, a miss of that magnitude typically signals a major operational breakdown. But the stock tested a yearly high. So what actually drove that negative variance on paper?
Well, the paper variance stems directly from non-cash accounting requirements. Tidewater had to book a C$39.50 million unrealized loss on derivative hedging contracts during the quarter.
Oh.
Yeah, when energy prices move, the mark-to-market value of those forward derivative contracts naturally fluctuates. So that C$39.5 million paper loss drags down the net income line and consequently the EPS.
Right.
But it doesn't impact the actual hard cash being pulled out of the facilities today.
That makes sense. I do want to address a critical data discrepancy from this morning, though, because if you use certain alternative financial feeds, you didn't even see an EPS of C&Honors 68 cents. You saw an EPS flashing at C&Honors 56 cents.
Oh, right, the scraping issue.
Yeah, which would imply a miss of over 50%.
The C$56 SIP figure that populated across several major financial media databases was just a direct result of automated scraping errors. You know, financial aggregators use bots to scrape EDGR or CEDAR filings the exact second they hit the wire.
Right, it's all instant.
Exactly.
Yeah.
And in Tidewater's case, the formatting of their financial tables caused the bots to bypass the standalone 3-month Q2 earnings. Instead, the algorithms grabbed Tidewater's 6-month trailing consolidated net loss per share, which happened to be negative C$2.56.
Oh.
Yeah, and it just populated that into the primary Q2 EPS field on retail trading platforms.
So an investor relying solely on an aggregator feed saw a catastrophic 50% earnings miss, while an investor pulling the actual corporate filing saw a C$68 print.
Exactly.
It's an object lesson in why relying on third-party data feeds during the first 10 minutes of post-earnings price discovery is just incredibly risky.
It really is. The official filing explicitly confirms the basic EPS for the 3 months ended June 30 was C$68. But honestly, even putting the data scrape error aside, the EPS metric itself is totally a distraction here.
Right, from the core metric driving the valuation.
Yes. The consolidated adjusted EBITDA hit a record C$88.90 million.
That C$88.90 million is up 79.5% sequentially from Q1, and it's a 5-fold increase year over year from the C$16 million reported in Q2 of 2025.
Massive.
It really is comparable to looking at your bank statement and experiencing a moment of panic over an automated transfer moving out of checking, while failing to notice that your annual performance bonus just cleared into the account. You are wealthier overall, even if the first transaction line reads as a debit.
The bank analogy totally works on a surface level, but in corporate finance, it's also about the quality of the cash. I mean, the C$88.90 million in adjusted EBITDA isn't a one-off asset sale or some tax credit true-up. It is recurring operational cash flow.
Got it.
Institutional capital recognizes that you can't pay down debt with a GAAP earnings per share metric, but you can certainly pay down debt with C$88 million in hard currency.
So let's dissect where that $88.9 million is actually coming from. It didn't just materialize out of thin air. The standout metric for me in this deep dive was the utilization rate on the renewable subsidiary, TSX ticker LCFS.
Oh, absolutely. That segment generated a record $56.0 million.
Largely because the renewable diesel and renewable hydrogen complex, the HDRD, ran at an incredible 111% utilization rate. They processed 3,315 barrels per day. I mean, how does a facility operate at 111% of its nameplate design capacity safely?
Well, running past 100% utilization without catastrophic failure or, voiding warranties basically comes down to targeted debottlenecking.
Okay, what does that look like?
So when an engineering firm designs a processing facility, the nameplate capacity is dictated by the narrowest choke point in the entire system. It might be a single heat exchanger that can only cool fluid at a certain rate, or maybe a specific compressor valve limiting the pressure loop.
Right.
Over the past few quarters, Tidewater's engineering teams ran diagnostics to identify those exact physical constraints.
So instead of building an entirely new plant, they swap out the specific components that are holding the rest of the facility back.
Precisely. You upgrade the metallurgy on a specific pipe, you install a higher capacity pump in one specific loop, and suddenly the entire facility can process 11% more throughput.
Wow, that's incredibly efficient.
Yeah, and because the baseline fixed costs of the plant are already covered, every incremental barrel processed past 100% drops straight to the bottom line at a much higher margin. Plus, they paired this debottlenecking with unusually high mechanical reliability. There was almost zero unplanned downtime.
And they pushed this record volume through just as the margin environment spiked. Their offtake contracts for the HDRD complex are indexed to U.S. import parity pricing.
Yeah, that index pricing is crucial. They're capturing the spread between the cost of their feedstock and the final market price of the renewable diesel, which is tied to the U.S. market. And on top of that structural margin, they recognize a $16 per liter biofuel production incentive, or BPI.
Which added an extra $7.7 million directly into the quarter's EBITDA.
Exactly.
So that covers the $56 million from the renewable side. The parent company, Deconsolidated Midstream, generated the remaining $32.90 million, and the Prince George Refinery, the PGR, was the anchor there, posting average crack spreads of $118 per barrel, up 16% sequentially.
Right, the PGR is a unique asset geographically, which gives it a localized pricing advantage, but capturing $118 per barrel is just an exceptional print for any facility.
Honestly, I have to challenge the sustainability of that $118 crack spread. It is a phenomenal number, but we know it's being heavily subsidized by global refining capacity going offline due to geopolitical disruptions in the Middle East and Russia.
Yeah, that's true.
If you are holding this stock, you have to look at that margin and assume it is a temporary macro distortion. If global capacity comes back online in the next 6 months, does that margin simply evaporate?
Well, leaving that exposure floating on the spot market would be reckless, absolutely. But management isn't doing that. They are actively utilizing financial derivatives to lock in this specific pricing anomaly.
Oh, really?
Yeah, they have executed a hedging program that secures 50% of their remaining 2026 crack spread exposure, and they have already moved further out the curve to hedge 40% of their 2027 exposure.
Okay, but what are the actual mechanics of locking in a crack spread 18 months out? I mean, they aren't physically storing the refined product for a year and a half.
No, they're using financial swap contracts. They agree with a counterparty to a fixed margin between the price of the crude oil they buy and the refined products they sell.
Okay.
So if the actual spot crack spread drops to, say, $60 a barrel next year, the counterparty pays Tidewater the difference up to their hedged price.
Yeah.
By doing this now, while spot prices are heavily elevated, they are securing a fixed cash flow floor well above historical mid-cycle pricing.
Which brings us to the capital allocation strategy. If they have a firm flow under the PGR margins via these derivative swaps, and the HDRD plant is running at 111% utilization printing cash, where is all that capital actually flowing?
It is flowing directly to the balance sheet. Consolidated net debt dropped by $44.4 million in a single quarter.
Retiring $44 million in 3 months materially alters the risk profile.
It fundamentally changes the conversation around the stock. The consolidated debt to adjusted EBITDA ratio fell to 1.7x. And management stated long-term target range is 1.2x to 2.5x.
Right.
For the last several quarters, institutional investors demanded a higher risk premium on Tidewater because the leverage was outside that comfort zone.
Oh.
Hitting 1.7x safely removes that specific balance sheet overhang.
And the guidance update is where the discipline really shows. They increased full-year EBITDA guidance by 20% at the midpoint. That is an incremental $40 million in projected cash.
Yeah.
Yet if you look at the capital expenditure guidance in the same release, it remains completely unchanged. They held consolidated CapEx at $20 million to $25 million, and renewables CapEx at a very minimal $2 million to $3 million.
Management is explicitly signaling that they are not suffering from mission creep. When commodity companies experience a windfall, there's a huge temptation to spin up new drilling programs or greenlight marginal expansion projects. But Tidewater is holding the line on capital outlay. Every incremental dollar from that $40 million guidance bump is slated to flow straight through to free cash flow to accelerate debt repayment.
It's the equivalent of receiving a substantial promotion at work, but refusing to inflate your lifestyle. You maintain your current budget and divert the entire increase in your salary directly into the principal of your mortgage.
Exactly.
The long-term compounding effect on your net worth is dramatic.
And they are finding margin outside of just operating revenues, too. During the quarter, management gave notice to terminate a crude oil pipeline transportation contract at the end of its initial 5-year term.
Wait, why walk away from a pipeline contract?
Because the tolling fees just weren't generating a sufficient return on capital compared to alternative transport methods. By allowing that contract to expire, they permanently remove a fixed cost from the letter, which frees up an additional $3.00 million in annual distributable cash flow starting in 2027.
So the margins are robust, the debt is dropping, and operating expenses are being actively trimmed. But if you look at the analyst coverage today, the consensus rating remains a hold.
Yeah.
We have to look at the structural headwinds that are keeping the street cautious. What is the bear case here?
Well, there are 3 specific areas of friction keeping the analysts on the sidelines. The first is the gap drag we discussed at the top of the show.
Right.
Despite the strong adjusted EBITDA, the company remains GAAP unprofitable over the trailing 12 months, posting a consolidated net loss of $76.27 million.
Right.
Even though we know a portion of that is non-cash hedging losses, a TTM net loss of that size restricts certain conservative funds from initiating a position due to their own internal compliance mandates.
The second headwind sits within the conventional midstream operations. The refinery and the renewables plants are operating efficiently, but the gas processing side is struggling with basin constraints. Throughput at the Brazeau-Ritter complex, the BRC, dropped 8% sequentially to 105 million cubic feet per day.
Right, and the BRC drop wasn't a localized mechanical failure. It was a symptom of downstream curtailments on the NGTL pipeline network.
Let's unpack the mechanics of a downstream curtailment because it really highlights how interconnected these assets are. If the main takeaway pipeline, the NGTL, is undergoing maintenance or is at capacity, they restrict how much gas they will accept from processing facilities like the BRC.
Exactly. A processing plant does not have unlimited storage. If the downstream pipeline dictates that they can only accept 80% of your normal output, you have no choice but to throttle back your upstream processing to match.
Wow.
Yeah, the BRC is physically capable of processing more gas, but there's nowhere to send it. That bottleneck dragged their fractionation facility utilization down from 90% in Q1 to just 76% in Q2.
And the Ram River gas plant faces an entirely different issue. It remains temporarily curtailed due to persistently low producer volumes in that specific geographic area. The midstream division is highly exposed to the macro reality of Western Canadian basin constraints.
It acts as a drag on the consolidated metrics. The renewables division is pulling the cart, while the conventional midstream division is fighting pipeline logistics and producer economics.
But the primary focus for the bears, the real point of contention on Bay Street right now, is the proposed Sustainable Aviation Fuel, or SAF, project.
Oh, absolutely. The SAF facility is the ultimate double-edged sword for Tidewater. It is their most significant long-term growth catalyst, but it also represents a massive capital overhang that is actively suppressing their valuation multiple.
The proposed capital cost for the SAF project is $1.27 billion. Management is targeting a final investment decision, the FID, in Q4 of 2026, with the plant not entering commercial service until 2030. They just executed a textbook deleveraging strategy to get their ratio down to 1.7x.
Right.
Are bears justified in worrying that funding a $1.2 billion mega project is going to blow up the balance sheet all over again?
Yes, and that is the exact technical debate happening on Bay Street right now. Near-term cash generation versus long-term capital intensity. The capital intensity of a sustainable aviation fuel facility is fundamentally different from a standard renewable diesel plant.
How so?
Producing GRAM requires severe hydro-treating, expensive specialized metallurgy to handle the highly corrosive nature of the biofeedstocks, and immense hydrogen integration. You cannot build a $1.2 billion facility off internally generated cash flow for a company of Tidewater's market capitalization.
The bulls argue that the current cash flow generation, combined with future government credits, validates the project. But the technical debate is whether the near-term cash generation is being completely overshadowed by the long-term capital intensity.
And the bears are concerned about the execution risk. A 3 to 4 year construction timeline for a first-of-its-kind facility carries inherent inflationary and supply chain risks. Even if Tidewater intends to bring in external infrastructure funds to finance the construction, the sheer scale of the capital required makes the market nervous. Until the exact funding structure is announced, the street will apply a discount to the stock to account for the uncertainty.
Which brings us to how the analyst community is digesting these cross-currents post-earnings. The consensus rating stayed at a hold, but the price targets were adjusted upward to reflect the cash flow and the debt reduction.
Yeah, the analysts are acknowledging the operational execution. National Bank raised their target to see $27. ATB Cormark increased their target to see $26, and Scotiabank moved their target to see $26 as well. The consensus average target now sits at $23.60.
Oh, okay.
They're giving management credit for de-risking the balance sheet today, but they are withholding the buy rating until they have visibility on the SF funding.
This sets up a very specific catalyst path for anyone evaluating this stock. If Tidewater can successfully secure non-dilutive funding or potentially finalize a joint venture partnership with First Nations groups for the 2030 SF project before that Q4 FID is signed, does it remove the capital overhang entirely?
That's the huge question right now.
If they can prove they can build the $1.2 billion facility without destroying the 1.7x leverage ratio they just achieved, this stock may finally break out of its historical debt-constrained valuation ceiling. Make sure to follow the show for your daily earnings coverage and market analysis.